would decrease. If its price is below the face value, it means the discount, its value would be increased to par value. So at the time of maturity, at maturity date, the bond market value must be equal to its face value, because on the face of the bond it is written 1000. So anyone who hold this certificate, he can present that certificate to the company and he can claim 1000. So whatsoever the price in the market, he would be given $1000 at maturity. Right, guys? So regarding these two concepts, we'll talk about in our coming slides. So just going to give you the hint that premium means if the value of the bond is right now traded above the par, it means that it's a premium bond. If the market value of the bond is less than its par value or face value, it means it is right now treated as discount. So now the interest rates that
Wait, sir, I have a question.
yes.
What is face value? That's the value currently, right?
No. Face value means the value that is on the face of the bond, which is which is 1000.
Okay.
Like you hold
The market value is the current value, right?
What, Misha? Can you repeat? Misha. Misha, what was your question? Can you please repeat?
Sorry, my connection's bad. I'm gonna just 5 more minutes. You can continue for now.
Okay, okay. You can always, stop me and ask questions, okay? Okay, let's move forward, guys. So now let's talk about how bond prices are determined. Now, how it can be possible that on the face of the bond, it is written $1000, right? And right now it is trading on the market at 101.5, which means market price is $1015. How it can be possible? So it means there is some other factor who causes this price to increase or decrease, and that factor is interest rate. So bonds always sold at market price. So if you want to buy a bond, you can go to the stock exchange, or if the company issues a bond, it will always issue at market price. So market price can be the present value of the bond, right? So there are two interest rates who sets the bond price. So let's talk about this. Okay. So we discussed that the characteristics of the bond is it is the face value, which is written 1000. Company name is going to be there. Maturity date. Issuance date. Right? And the interest. Right? So that interest rate which is written on the bond we call that interest rate as coupon rate or coupon interest rate. Everybody, please listen. The interest rate that is written on the coupon rate, on the bond, we call that coupon rate, right? So it means company has contracted you, or companies has in the agreement with you that he would pay you 10%, 10% semi-annually, and that's it. And there is another rate which is called the market rate. Can be okay, I think I should change the color so that it will be more meaningful. The other we call that market rate, bank rate, or yield to maturity, right? So there are other rates in the market. For example, company is paying me 10%, but what is the bank rate right now? So these rates are interchangeable. Okay, so don't be confused with the words, right? So I'm not going in, into the into these defining these three terms, but remember that this is pure finance stuff. So right now, just remember that there are two interest rate. One is the market interest rate, and one is interest that is written on the face of the bond. We call this coupon. So here comes the real deal. So guys, I need your participation. Everyone, please be attentive. So if the market is offering you 12% interest rate and coupon is giving you 10% rate, what would you do with your money? Sipade, would you like to put your money with the company, or would you like to put your money with the bank rate or with the market rate? Sipade, can you hear me?
Yes.
So it's your money, right?
Market rate?
Of course, right? It's your money and you want to earn maximum return, right? So company is giving you 10% and market is giving you 12%, right? So you want to invest your money at highest rate, right? What about the, okay, it means market rate is greater than coupon rate. So in that case, supply of the company's bond increase or decrease, or you can say demand increase or decrease. Just forget about that. In that case, the demand for company's bond, supply is there, but demand for company bond increase or decrease. If market rate is giving you 12%, company is giving you 10%, the company's bond demand decrease, right guys? So it means company's price decrease. So I'm gonna just removing all these mess here and giving you a fresh start. So please don't mind. Here we go. So again, there are two rates. Any confusion regarding the two rates in valuation of bond? So we have market rate and we have coupon rate.
I don't get the difference between these two. What is the market rate? What is the coupon rate?
Okay. Coupon rate is the rate that is written on the bond, that no matter how much is the interest rate in the market, but company will pay you 10%. So that is called coupon rate.
So you add that to the market rate?
No. The market rate is what is the interest rate, the actual interest rate in the market. For example, bank rate, right? We call
Okay.
that
Yeah.
market rate. Okay. So there are two interest rate in the valuation of, and that is pure finance stuff. So I'm just giving you a very simple example, not going into pure finance stuff, just making you understand that. So there are two interest rates when you value the bond prices, the bond market prices. So one is called the bank rate or the market rate, right? And one is called the coupon rate. Coupon rate is always given to you, and also, but you need to find out, this is also given to you, the market rate, but you need to find out through the question that what is the market rate. But coupon rate will be 100% given to you. You can see that the company issued the bond at 10%, means 10% is coupon rate, right? So if market is giving you 12% and company is giving you 10%, what is the demand of company's bond? Demand for company bond will decrease. Demand for market rate will gonna be increased. So people sell the bond and take that money and invest in the market to earn that 12%. In that case, the price of the bond decreases. When the price of the bond decreases below the par mean its original value, 1,000, we call that bond is now selling at discount. Then you can apply this concept to your daily, goods as well. So if one market is giving you cheap product and the other market is giving you the same expensive product, you want to buy a cheap product. But with respect to your money, if you want to save your money, you want to earn higher return. So you will buy that instrument which increase your wealth. So you demand that one. So demand for market rate gonna increase, demand for coupon rate gonna decrease, right? Because it is giving you low return. In that case, the price of coupon rate instrument, which is the company's bond, decreases. When demand decreases, it means price also decreases. Right, guys? You can
So
just,
they balance each other out in the long run?
in the long run, for example, the bond is issued for 5 years. After 5 years, the value must approach to 1,000 because this is a debt instrument and you are promised, company is promised to pay you 1,000. That's it. So at the end of 5 years, company is giving you 1,000. Again, because this is, I really understand that this is a really, difficult concept. So I'm going to be repeating it many times so that until you really understand that. So I'm just clearing all my drawings.